Hey y'all, Jen Hernandez, Loan with Jen. How to finance multiple investment properties. We will be right back. Okay, we're back. So financing multiple investment properties, there's several ways to do it, but I'm just gonna go through a couple of the most kind of easy to understand how people try to envision, how am I going to stair step and accumulate these properties? Probably the first way to finance multiple investment properties is what we're talking about, is purchasing your primary. That's the very first purchase probably that you make, is find somewhere for you yourself to live. Now you need to live there at least a year, because you're signing a document, a deed of trust, and a financial obligatory instrument at the closing saying that you intend to live there for a year. So if you don't, and then you vacate that property and go rent it out to buy another one, the lender's gonna be like, well, this guy was lying. I'm just gonna put it to you right between the eyes. They think that you are doing something weird. So you got to stay there a year to avoid all suspicion, and stay there a year, and then after a year you can, improve it or do whatever you're going to do, and then you want to rent that out. So we see a lot of investors stair step that way. They'll live there a year, then they'll say, okay, I'm going to get a renter, I'm going to get $1,500 a month rent on this property, and I'm going to go buy my other primary. So then they buy their next primary. And we can use rental income from the departing residents as long as it's a conventional loan. FHA does not, if you're doing an FHA on the new second loan, they do not allow rental income on a departing residence, okay? So it's very important. We can use 70% of the rental income towards offsetting the payment on that debt, okay? So remember, conventional only, we can use departing residents' income up to 70% to help offset that payment. Now, the second thing, so let's say you've got your second primary home and you're there, and let's just say you stay there for a while, okay? You're gonna stay there, it's your house, your kids live there, you're not gonna vacate it, you're just stuck right there. And you're gonna amass some other investment properties. So Fannie Mae will allow up to 10 financed properties. So let's say we're on number 3. So you've got a rental and you've got your primary. The third one would be an investment purchase. Minimum down payment is 20%. Prior to COVID, it was 15. Post-COVID, it is 20. Your best interest rate, by the way, is going to be when you're at 25%. So you want to talk to your local lender about, options as far as that goes. So you put your 20% down, expect that the rental property interest rates are anywhere from 0.5% to 1% higher than a primary rate interest rate. It's just the way it is, just the cost of doing business. It's because investment properties are deemed as riskier. They're viewed as riskier by lenders because if times go bad and there's a recession or you lose your job, you're going to hold more integrity with the payments on your primary residence. You're gonna be like, I'm letting that investment property go. I'm gonna pay my primary because that's where my kids live. That's where that's where my homestead is. This is how lenders think, okay? I'm not saying that that's true, but that is why investment properties are held at a higher risk level than primary residence properties, okay? So just to repeat a couple of things, 20% down minimum on an investment property purchase. We can use 70% of the rental on rental properties. If you don't have a 2-year history of tax return rental income, that's okay. We can see a lease, not a problem. So talk to your local lender about qualifying as well. But how to finance multiple investment properties. And we hope you found this helpful. Talk to you soon. Legacy Mutual Mortgage is an equal housing opportunity lender. The opinions expressed here do not reflect those of Legacy Mutual Mortgage.